Welcome to the XFO Intelligence podcast channel Market Pulse series. Today, we're diving into a seismic event that's rewriting the financial rulebook. The $1.8 trillion recalibration, why the June 2026 market sell-off is a structural regime change, not a correction. It's the 6th of June, 2026, and I'm here to break it all down. The $1.8 trillion wipeout in the S&P 500 and the Nasdaq's historic plunge weren't just market jitters. They signaled a violent structural regime change in global capital. For years, we thrived under near-zero discount rates, unchecked mega-cap tech growth, and passive index dominance. That old paradigm is broken. Geopolitical supply shocks, a surprisingly strong labor market, and the Federal Reserve's hawkish pivot have fundamentally rewired how capital flows. First, the stagflationary squeeze. Ongoing tensions near the Strait of Hormuz have driven up energy and freight costs, yet the U.S. labor market is booming. A solid 172,000 jobs added in May, thanks to reshoring and a tight services sector. This leaves Fed Chair Kevin Warsh with no easy options. Inflation remains sticky, and bond markets now fully price in a rate hike by year-end. Next, the AI valuation reckoning and the passive trap. Massive AI infrastructure spending has outpaced software monetization, and as rates rise, valuations shrink. The heavy weighting of mega-cap tech in the S&P 500 forced passive funds to sign mechanically, creating a liquidity vacuum. Then, the great capital rewiring. As traditional financing clogs, capital is pivoting to leaner, higher-yield paths. Token-backed mortgages and tokenized real-world assets are capturing market share from traditional banks by offering faster settlements and higher yields. We're also seeing index gatekeeper arbitrage. The addition of Marvell and Flex to the S&P will force passive inflows, while high-profile IPOs like SpaceX risk exclusion and extreme volatility. What's next for the next 90 days? In July, expect continued volatility and capital pooling in short-term treasuries. August will bring movements into inflation-linked assets and alternative yields. By September, demand destruction will set a new market floor, shifting the S&P's profile toward value, energy, and industrials. Strategic imperatives. Avoid passive liquidity traps. Stay away from assets where passive ownership tops 40%. Embrace short duration and floating rate instruments. Position for supply-side realities. Think energy infrastructure and defense. And monitor alternative financial infrastructure. Tokenized real estate isn't a fad. It's solving real inefficiencies. Bottom line, the market isn't broken. It's running on new rules. The era of free money and tech momentum is over. Winners will chase tangible yield, security, and efficiency. Thank you for tuning in to the Market Pulse series. If you enjoyed today's episode, don't forget to like, share, and subscribe. For feedback or to request more info about our new Thought Leadership On Demand service, email us at xfointelligence@gmail.com. Disclaimer: this content is for informational purposes only and does not constitute financial advice. Always consult with your financial advisor before making investment decisions.